that time of the month when we have a couple of economic data releases. First up is the core sector data. The core sector in India is an index that tracks the 8 most fundamental industrial sectors in the economy. Now it shows us how much these sectors are producing and also indicates the overall functioning of the broader economy. In the month of June, there has been a positive development in the growth of the core sectors, reaching a 5-month high of 8.2%. Now this comes after a growth rate of 5% in May and 4.3% in April. Also, the growth in the core sectors has also been broad-based. On a year-over-year basis, the growth has been positive in 7 out of the 8 core sectors, but there was a marginal decline in the production of crude oil. The core sectors we just discussed can be likened to the vital organs that are essential for an economy's overall well-being and functioning. Now, these sectors are responsible for producing the basic necessities and key inputs that other industries heavily rely on to operate and grow. When these sectors thrive, it's indicative of a healthy and growing economy as a whole. Despite facing persistent global challenges, India's economic activity as measured by core sector output has performed quite well. However, there are potential headwinds looming in the form of a global slowdown which could impact both global and domestic demand. Yet we remain optimistic in the long term due to the government's aggressive capital expenditure investments. These investments are expected to stimulate growth in the core sector, thereby providing a boost to the overall economic outlook of the country. A government's fiscal deficit shows the difference between the total expenditure and revenue of the government. In simple terms, it's like a shortfall in the government's income compared to its expenses. Recently, India's fiscal deficit for the first quarter of the current fiscal year increased to 25.3% or Rs 4.5 lakh crore of the budgeted estimate. Now, compared to the corresponding year, it was 21.2% of the budget estimates. So we see there's been a significant increase in the deficit. During the same period, both total receipts and revenue expenditure were down compared to the previous year. But what really caused this higher deficit was the increase in capital expenditure, which rose to 2.78 trillion in Q1, up from 1.75 trillion in the previous corresponding year. Also, there was this thing about transferring a double installment of tax devolution to states. An interesting bit from the data was the non-tax revenue. It got a significant boost because of this huge dividend received from the RBI amounting to Rs 87,000 crore. Now, the government has set a target to bring down the fiscal deficit to 5.9% of the GDP during fiscal year 24. Now, that's their plan for fiscal consolidation and it's a welcome move. Another good thing is that the higher than budgeted dividend surplus transfer from the RBI is expected to help offset the extra spending on capital expenditure. It should also ease any reduction in revenue and cover any overshoot of expenses from the budget. Overall, the government's finances seem to be in good shape, and let's hope everything goes as planned and helps the economy move in the right direction. Having said that, this is me, Zana, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Equity investments are subject to market risk. Read all investment-related documents carefully. Visit www.researchandranking.com